yes, I missed the meeting and I get hosed.
But you learn from it.
I learned from the minutes.
Or don't miss
Not
the
being
meeting.
there, exactly.
But you didn't get put on 3 committees.
I don't want to be on a building committee.
See, you'll miss again.
Already a terrible one, I'm good with that, but, what do I mean? Even if I'm not, I just want to, I have a way to communicate that and send over the stuff itself, and now that I've learned more about how I'm doing it, and it's just like, this makes sense. Me, I mean, there's more efficient ways to do it and lower risk with my expected. Yeah. Right. Sure. Yeah. Yeah. And CITs are customized password. I would trade off to the cheaper. I mean, it's like, having customized contracts absolutely better, but there's more like work on problems. But okay. But we want to think it's better, it's, manager, whatever, and, use the leverage reaction. It's like, you want $100 million, whatever it might be, then you're gonna compromise, but. Yeah. Yeah. Right. Yeah. All right, that's cool. I mean, I'm sure Tom will tell me what happened at that committee meeting when it happened, but I was just pissed off with town. Yeah, I know. I'm very curious if I don't have clearance. It seems like it's a room.
Yeah, I think it's out.
Cool.
Good to see you.
You know,
I think it's actually. Yeah, I think it's easier to sell.
Thank you so much.
Testing. Testing.
No, you're right, chair. I don't want to be, then they'll make me the chair.
Testing, testing, testing. 1, 2, 3.
This is for you.
When they're off that. It's a meeting. I'm kind of with.
Like I'm writing, there's like I kind of think of it. Inspire. One challenge. but you.
Yeah, whatever, it's not.
A lot of stress. And there's like, it's all, and it's big narrow, and you can veer from one side to the other, right? It's a little-
Oh,
Yeah. But.
she figured that out. I wouldn't mind submitting an extension for it, but. Yeah. Oh, lame. Well, I can submit it to you and then you could submit it. By the way, improvement his gravel. It's always been that way.
Yeah.
Start scrutinizing it a little bit more, Tom,
Please do.
depending on what I get at.
I love it.
That's well, you didn't hear that. I know, you better not. Okay, okay. Yeah, no, I appreciate that. Lots of pride.
No reciprocity.
So he's got one with three and this, yeah, and the. But you know. So that's what that means that.
Oh, I don't want
Yeah,
to.
Sit out there.
You'll take a presentation.
No, I meant like in the red shirts.
Way up.
Way in back. Look at that. All different.
Yeah.
Good, yes, sir.
Really good. This, I can see it.
Yeah.
Work.
Oh. Well, you know.
I know, Joe, you know, when you're meeting with Mayor Pratt. Doesn't tell you to put that.
Yeah.
Yeah, well, let's see. So, right. You never know. Never know.
Yeah.
I'm near enough to retirement. Revert back to my old job. There's tell these. I have to do it. We'll make time up there.
Yeah.
No, I'm fine with it. I mean, what, do you have? Or do we do it before or after?
Or your calendar.
I'm on. Oh, okay. Kind of like, yeah, it doesn't. Yeah, same here, yeah.
I wanted to sit down, I think there was going to be a lot.
I mean, I'm fine either way. I just. I think it's always good.
That's who I mean. Thanks for talking.
No.
You guys want to talk?
No. You raised it to 8% now? Huh? Raised it to 8% now? You know, we're over 11, right? Brian is good. Hey.
Yeah.
Yes, sir. Oh, and you seen that? Oh, 100%. Yeah. Yeah, and it's a small group anyway, but look, I mean, the bargaining units, this is just a test because the other bargaining units, the city bargaining units. Hopefully, right, it's a good day, so. Yeah. Yeah, okay.
Let's not make things apart.
Exactly. I mean, IBW is going through the contract right now, so I was a little confused on like the pause. I'm sure they'll explain it today, but like how the pause is gonna roll. Yeah. Either way, I'm in the process. Okay.
And actually, I use in running.
Oh, you are, okay. Cool. You probably have similar aspirations, contracts.
like right now.
Is it, yeah, everyone's trying to play the timing, right?
Yeah.
Well, I don't, we're not.
So yeah, I'll try to, let's see what they talk about the program. I'm gonna send it later.
We are. There are, they just came through, they're gonna, in fact, the next board meeting, no, we're gonna have our grand study. You just came in and trained the board, we have some new members on it. I asked, I'm like, I don't know. I'm here. I'm a while back. We've been out of a while and, there's no an outlier on there. Like, really, so, okay, that's not something that you expect, you know, in 10. Like, that's when he brought it. So I go, oh, yeah. But, yeah, so I guess it's still. Yeah. I mean, I was not. Not the unit, I was surprised. They did, but they convinced me to pay up front versus they can come on load and they can help. So if you think about it, we're over 100% funded, like you read, and then we're also have a lower actual. And you know, we're gonna have a big drop yards, so Senate payroll by 16%. Right, everything got drawn. Yeah.
Yeah, I think the biggest issue I got, my board. is, Hey, we're doing so well, we're like 20 to 30 to 90. Okay, yeah, you can look at the path.
Yeah, oh, yeah, exactly.
But, I mean, the ultimate outcome. They've asked for it, bring it back, if conditions warrant. What.
Time to go out.
Who gets which ones are on?
They've been great for a long time. But
Yeah.
every once in a while, it's
Yeah.
gonna change. Yeah, we had them 2020 as well, yeah.
And they have a monopoly, they come to TDP as well.
Well, because of that, it works well when they're working with the city too, because
Yeah.
like they understand everything, right? But
So,
that's life.
yeah. Um, Yeah, a little. I picked the 210 all the way out.
Okay.
So yes, we're looking to go north. Okay. In the area?
Okay. Good morning. This is the special meeting of the Board of Deferred Compensation Administration. Let the record reflect that board members Mattis, Wolfson, Salazar, Wright, Phillips, and Bowie are present. A quorum of the board is established. Board Chair Tom Mattis will be presiding over this meeting. For the record, I am Deferred Compensation Plan Manager Esther Chang, and also present is Legal Counsel Charles Hong.
Thank you, Esther. With that, I'll call the meeting to order at 10:06. First order of business is public comments.
Any person wishing to make a public comment, press *9 to request to speak and press *6 to unmute and speak when prompted.
Musical interlude. I've done that before.
Sure.
Okay, just 1 second. Let us
Nope.
make sure the audio is working appropriately. Okay, we're good? Okay. So just one more time, any person wishing to make a public comment, press *9 to request to speak and press *6 to unmute and speak when prompted. Do we have any callers on the line? No. No public comment at this time.
Okay, thank you. So we're going to take the agenda a little out of order this morning. We're going to defer the administrative items until later, and we're going to move directly to the informational items, the first of which is the Mercer Quarterly Investment and Economic Review for the first quarter of 2026.
Great. Good morning. We have Christian Galen with Mercer present today.
Good morning, Anna Tomchow from Mercer.
Great. So regarding the quarterly performance review, we'll start with a market overview and move to some plan level details, and then a review of the performance of the funds. So with regards to the performance, the market overview, I'll start on slide 3. We do have some new slides for you today regarding sort of market themes, trends. I'll stick to some of the key slides here, as some of it is supplemental as well, but I'll call those out to you. Beginning on slide 3, good overview of key events and market drivers for the first quarter of 2026. I think the key thing to note here is thinking about the past 3 years were really punctuated by sort of double-digit returns in global equity markets. The first quarter of 2026, however, we did see some headwinds, performance, and clearly some investor sentiment changed, as well as some macro events. And as outlined here on the page, principally what we're seeing is clearly from a thematic perspective, the AI trade was a big tailwind in 2025. A bit of a headwind in first quarter of 2026. I think there's a bit of a bifurcation in the theme here, in that what we're seeing is chip manufacturers, hardware related to AI has really been performing well. Investors have really been allocating to those names. What we're seeing, however, is AI disrupting sort of software. So this idea that the disintermediation of software due to AI has really been a headwind for some of these software companies. That's one thing that we saw in the first quarter. There are also some other regulatory and macro events, including sort of the Supreme Court overruling, the administration's tariff policy as well. I'd say the market moved past that pretty quickly given the sort of start of the US-Israel-Iran conflict. And that really was a headwind for performance in the first quarter as well, given sort of the disruption related to kind of the war, but also sort of the bottleneck in oil production coming through the Strait of Hormuz. That's been a headwind from a macro perspective, but also has really resulted in sort of general inflationary fears as well as increase in oil prices as well. So interestingly enough, throughout that period, the Fed has continued to hold rates steady throughout the first quarter. Inflation did fall during the quarter leading up to the conflict, but has since increased as a result as the price of oil has continued to kind of drive those inflationary fears. On the next page, just looking at the performance on slide 4, getting more into sort of the numerical details here. Global equities were down 3.2% for the quarter. U.S. equities down 4.3%, as represented by the S&P 500, and international equities, developed markets down 1.2%, and emerging markets down 20 basis points. So, broadly, we did see some headwinds to performance, as I noted, due to those drivers. However, post the first quarter, just kind of looking forward to the markets and thinking about kind of year to date, as of yesterday, June 2nd, there's been, quite a tailwind, especially as relates to some of the AI-driven trades. We saw kind of a run-up in that infrastructure, AI-driven semiconductor names that I had mentioned, and then earnings have continued to be solid as earnings season reported as well. So performance has turned around year to date through June 2nd. S&P 500 was up 11.7%. Global equities broadly were up 13%, and a lot of that driven by sort of IFA, which is the international developed markets, and emerging markets were up over 28% as of yesterday. So a bit of a turnaround, and a lot of that too is off the back of some of the conflict resolution and narrative that we're seeing out of the administration around the Iran conflict as well. So some sentiment driving that as well. On slide 5, you can see just what's kind of driving returns through the first quarter and a little bit more illustrative graphically regarding kind of the I would say the dispersion of returns in the first quarter, looking at some of the majority of sectors kind of seeing that kind of headwind and underperformance relative to what is broadly the largest returning sector in first quarter, that is energy, and that's coming off sort of the back of the supply strains off the Iran conflict. Again, thinking about year to date, a lot of the performance headwinds have been kind of shrugged off to some degree, although oil continues to be elevated, inflation concerns remain. So I'll pause there. Any questions? Okay, great. With that, we'll move forward. I'll hand it off to Anna, who will continue on slide 12 here.
Okay. I'm going to walk through the performance of the deferred compensation plan as well as the assets. As Christian alluded, first quarter of 2026 was a very difficult market environment for both equities and fixed incomes. So value outperformed growth during the quarter, and small cap outperformed large cap. And within this market backdrop, it would explain most of the results from across the plan. At the end of March 2026, the plan had 11.9 billion, and assets declined about 335 million during the quarter. And most of this decline was due to investment losses of about 286 million and partial net outflow of 49 million. moving to page 14, here you can see the structure of your plan, which shows it remains a strength for the plan, as the plan continue to offer the risk-based 5 profile funds, as well as it has a diversified white label core menu that has a mix of passive for efficient markets, as well as active that bring differentiated returns potentials. And then for also has a brokerage window for added flexibility. Moving to page 16, we have an update on Galliard. They announced that Mike Norman, who's the senior managing principal and president of Galliard, is planning to retire at the end of the first quarter of 2027. The firm is expanding its leadership team structure to support this transition. And it is Mercer's view that this is an orderly and well-structured succession plan, so we don't have any concerns. Moving to the performance of the plan, I'm going to skip the other. Let's go to page 21. This is a new exhibit on the report. As you are aware, Mercer rebranded. In this exhibit, you can see the Mercer ratings on one of the columns for each of the options, as well as the long-term performance. The red represent underperforming the respective indices, and the number in parentheses are the percentile ranking. A lower number is better, and higher numbers worse. As you can see, most of the funds has been outperforming. The red numbers that you can see is pretty lower margin. And if you flip to the next page, some of the diversification within the white label funds has helped. For example, for the DCP small cap stock fund, which is in the middle of the page, you can see though Hartford has underperformed for most of the periods, the fund has remained strong for the 5 and 10-year periods. So diversification within each white label fund and having a value and growth style will help, as you will see when we look at the actual performance of each of the funds.
Excuse me, would you mind to talk a little bit about the ratings comments? We have some that indicate monitor, and just talk a little bit about what these ratings mean and what we would expect from the monitoring standpoint.
Sure. So Mercer has a global research team who they are in charge of reviewing and meeting with all the investment managers that we rate. And an A indicates that we believe the strategy has a future, what is the word, of outperforming, the index. So this is a future looking, forward looking. For our ratings, that means that either our research team has stopped reviewing that strategy or is not rated. And we also have B rating, B plus rating. B is a look of outperforming the index, but not as best as the A rating managers.
And just an additional comment there. So yes, we report the performance, but to Anna's point, the rating system is also a qualitative rating. So we do want to look at the firm, the structure of the team, their philosophy, and also understand any sort of deviations from that philosophy. And just based upon those factors, as well as historical performance, assign a rating based upon sort of the forward-looking outlook and kind of a conviction regarding the ability to outperform over a full market cycle.
Do you guys, does the criteria for those ratings change over time? How often do you reevaluate them? How consistent are they?
Yeah, so the ratings themselves, the structure of the ratings is pretty fixed for a relative. So you have a good kind of relative basis when you're thinking about the ratings across managers. The frequency with which we meet with different managers can vary depending upon conviction, their utilization amongst our client base. Kind of noteworthy changes that have occurred may result in more frequent meetings. So to the extent there is like a monitor or a change where we want to oversee, say there's a change in the portfolio management team or a leadership structure change, we may meet more frequently with that manager just to ensure that we agree with the process and the way things are going and can retain sort of that rating. And and to the extent our manager research team disagrees, that can result in a rating change as well. So to your point, the degree with or the extent to which they're reviewed and the frequency with which they're reviewed can change depending upon the asset class, the manager, and the utilization within amongst our clients. Thanks.
Does monitor potentially progress one way or the other back to potentially retain, or is there another level below monitor where maybe there's a recommendation made relative to the disposition of a particular managers? How does that work with the monitor label?
Yeah, so that is, I'd say it's more qualitative than that. It is sort of like a review. We look at the performance, again, any kind of update that our manager research team has provided. To the extent that underperformance continues, it can be prioritized at the time of a search. And so we do kind of think about them in the sense of what's been performing, the recommendation, but to the extent we see sort of a dispersion in returns, especially amongst peers as well, because, in certain environments, underperformance to a benchmark can be expected, but also understanding how they perform relative to the peer universe and whether they're alternatives plays a role in sort of the monitoring component and kind of the forward-looking treatment and recommendation.
Thanks. And so maybe this might be a question for staff, but remind me when we would be again looking at our investment managers and evaluating potentially going out to bid and such.
So just as a quick recap from the last meeting in March, we had reviewed the investment manager selection. So at that time, we had the board had approved staff's recommendation to cancel that round of procurement. So we will be returning back to the board with the suggested timeline. And one of the options that we would be looking at is to start, I think just informally now, it would be some sort of a staggered timeline. So we would start with some of these funds that are indicated as monitor and then proceed from there. But we will be returning to the board with that timeline as we do need to, again, address now reviewing these options since we've canceled that last round of procurements.
Thank you.
Thank you. Now moving to page 24, we'll delve into the performance of your options. On the top, you can see the 5 risk profile funds. Although they have a recent underperformance due to the current market environment, the long-term performance has been very strong. In the middle of the page, you can see the large cap stock index fund, large cap stock fund, which is comprised of the Vanguard Institutional Index, 100%, and it's been tracking the respective benchmark, the S&P 500, as expected. On the bottom, you see the capital preservation options. They have underperformed slightly the benchmarks, the respective benchmarks, but the performance versus peers is very strong.
And just a quick question on the peer rankings. So those are percentile rankings, but how large is the universe? Just ballpark for like each one, how many constituents are in there?
Yeah, I don't have that information on hand, but I can get it for you.
I was just curious.
Yeah.
It's a large group.
Yeah, the reality is the universe changes depending upon the asset class and then the strategy. So to your point, in S&P 500, there's a really good sample of passive index also on the active side. But as you start to whittle it down into small, and you think about style, the universe can change and shrink a little bit. So it varies depending upon sort of the offerings
It's more directionally relevant than it is specifically relevant because they aren't exactly the same as us.
That's right. It's not necessarily the same, but I think it's indicative of the universe, and then within that universe, some of those may be relevant to defined contribution plans, and so it is kind of a more, to your point, indicative. Yeah.
Thanks, Chris.
You're welcome.
Yeah, and to add, I think for the stable value fund, there's about 18 options because we do the stable value survey every quarter. So, but money market, I'm not sure.
No worries. Thanks.
Moving down to page 25, you can see the performance of the DCP bond fund. It has matched the benchmark for the quarter, and long-term has outperformed the index. The fund's underlying fund, which comprised of the active Loomis Sales Core Plus fund, has performed pretty well across all periods. So no concerns there. Moving to the DCP Mid-Cap Stock Fund, you can see it outperformed the benchmark by a pretty good margin. 0.1 is positive versus negative 1% for the benchmark. And this was actually helped by the underlying fund Virtus Ceradex because of the quarter's rotation to value. It has favored that strategy. And despite Voya underperformance, because of the growth bias is out of favor, as well as they also has some poor stock selection in healthcare, consumer services, as well as consumer staples. You can see that the strong results of the Virtus Ceradex fund more than offset, the negative performance of Voya. So having both style, growth and value exposure is play out in your favor. Moving down to page 26, the DCP Small Cap Stock Index also outperformed the index 2.4% versus 1.3 and plays above the index of the universe. And the underlying funds all outperform at the respective benchmarks. And lastly, the DCP International Stock Fund underperformed the index, and it was mainly due to MFS. And because MFA has sort of like a growth tilt that was out of favor, as well as it's a quality manager and pretty defensive. So what Christian was explaining, they invest a lot in software. So they were hurt by the AI where investors allocated a lot of AI high volatility companies. Brandes and DFA performed well during the quarter. Any questions on performance of the options?
Go back to, sorry, can you go back to page 24 and look at this conservative profile?
Okay.
I'm looking at this conservative profile, and if you look at the 5, 7, and 10 years, over that period, it exceeds the market and it has quite good ratings. And the market was going up over those time periods. More closely, the market's been down and it has done worse than the market overall fairly significantly. That performance sounds like it outperforms on a good market and it underperforms on a bad market, which is not what a conservative profile should be aiming to do. I'm wondering if this profile, in your opinion, is not conservative enough, is too aggressive, and why that's happening, because it should be it should not be dropping from 11th percentile down to 70th percentile. That's not what people want a conservative portfolio for.
I appreciate the question. So there's a couple things to consider here, because agreed, there's some near-term underperformance. I would note that the conservative profile is clearly going to be a mix of fixed income and equity, and really what's driving this, the underperformance across, I would say, largely the all the target risk profiles is some of the recent underperformance in the active equity space. Right, largely in 2025, some of this kind of low quality headwind or low quality rally, when a lot of these underlying managers are sort of have a quality bias, that has been kind of a trend. The other thing too, though, is when you think about the conservative profile, it's not just the tracking, but also the volatility of the return profile relative to some of the other profiles. So you'll see here the return variability is going to be not as extreme as, say, some of the other more aggressive profiles. And that is also sort of a risk factor that is taken into account when designing sort of that asset allocation. So it's not simply just the tracking, but to your point, though, your point's taken on the performance and then the relative tracking of the benchmark, but also just the volatility relative to the other risk profiles. And that's what makes it conservative. So we don't have the risk figure here, but it's the it's in the, so we do have it on, if you want to go to that page.
So if you go to page 31, you can see we showed different characteristics of all the options. You can see that the standard deviation with representation of risk, that's the very first column. You can see how ultra conservative through aggressive, the standard deviation increases. So that is the risk. This is a point in time. This is 5 years ending March 31, 2026. And if you go to the third column from the left, which is a down market capture, that means how an option has performed during a down market. And you can see the number for the conservative profiles over 100%. That means that it has protected well. If the number's below 100%, it's not protecting as well.
And then just back to the point on the volatility specifically, because I think that was your question. It's the standard deviation column. You can see the variability in return, right, relative to the other profiles. That's the lower volatility, the lower variability in return is sort of what we would expect as well. So we think of that as have lower risk relative to the other profiles. So not necessarily in isolation, although do take your point on the relative performance to the benchmark, but comparing that kind of asset allocation relative to the other target risk profiles. And then
That's what I want to figure out is why is
Mhm.
R1 70th percentile performance to protect the downside. And I get that there's a strategy, but even compared to its own peers, it's not doing as well. And so I wonder if somebody can figure that out. What part of that portfolio is causing that? Something that was
I would, and a lot of that will be, to your point, that's borne out in the manager searches. So some of the fund performance, the underlying fund performance, but also note that the peer universe itself, there's variability in what a conservative or ultra conservative asset allocation might be too. So from a ranking perspective, there's some variability there too versus kind of custom, which is this is versus sort of off the shelf managers too. So I just want to point that out too.
Is that even
It's useful and indicative, I would agree, but just noting that there can be some variability. Sorry.
Then let's
Pardon.
figure out why 70, maybe part of our review of our investment options, think about why this one in particular is another one too, 69, 53. Most of our profiles are underperforming where they're supposed to be, at least in a down market. That's more important than capturing all the upside, depending on the downside. And so I'd like to know why that is.
We can.
That's a valid question.
We can take that back and let's dig into that a little further. I think that ties into the earlier question about additional information regarding the universes as well. So I think a little bit more detail on the universe for each profile, and then digging into the underlying funds that are feeding into it. So we'll come back with that information.
Just a point of clarification just to make sure I understand what I'm looking at correctly. When we have the asset allocation options, and then there's 3 listed under it, say like the conservative profile, for instance. And so that will be our conservative profile, right? And then we'll have the conservative profile custom index. And so this is the index, and the index is being measured against the range, I guess, of those firms within your survey. And then the Mercer Mutual Fund target risk conservative median would be your sort of benchmark or span of funds that are under that. Is that correct, or more or less, or?
Yeah, I want to clarify. Okay, so to your question on the benchmark, the profile custom index, that is represented by passive indexes with the same weightings as of the different asset classes within each risk profile funds. And then in terms of the Mercer mutual fund target risk universes, they, the asset allocation dictates how a plan, perform. And because if it's universe, there's a mix and mingle of different types of allocation, target allocation. So it's not really true apple to apple to compare, the fund, but it's the best benchmark we can provide for risk-based funds. I don't know if that answered your questions.
Yeah, I think so. Okay, and then so then the index ranking is, so the index is being ranked with respect to the other two
Correct.
funds within that.
In the same universe. Correct.
Thanks.
Okay. Okay, we'll bring more information on why it's ranking 70, but I think it's because of the mingle and mix of different type of target allocations within the constituents.
Anna, sorry, I don't want to give you too much extra work, but is it possible, instead of just bringing back a one-time, to put maybe an attribution slide in your quarterlies so that we can see what is the key drivers of performance within those portfolios on a regular basis? That would explain maybe and answer some of these questions regularly, because it's going to change over time. It could be a number one ranking tomorrow. So, I mean,
It will change over time. To your point, there's the asset allocation, but then there's also the performance of the underlying managers. And so attributing whether it is due to allocation or performance of underlying managers is
so something
to be
simplistic
reviewed.
that the board can consume of those buckets that are allocated. Of course, they're manager by manager, but if it can be a regular slide or two, maybe if the board wants it, maybe the board doesn't even want it, but maybe that would just help show the trends over time.
I think that gets back to your point regarding the attribution and the why. Yeah, certainly.
We'll do that. We will do that. Lastly, just wanted to bring you to page 29. And if you look at the effective net expense ratio, which is the 4 column from the left, all of those, all of your options are below, the cheapest institutional peer group fee universe, which is the 25th percentile. So it's very competitive fees in your plan. That's all my prepared remarks. Any other questions?
Any other questions for Mercer? Hearing none, thank you for coming in today on a day that is not a normal board meeting day for us. So we appreciate you coming in.
Thank you.
That will jump back up on the agenda to administrative items. The first is item number 3, the minutes of the March 17, 2026 regular board meeting.
Motion to approve.
Second.
A motion, a second. Any questions or comments? Hearing none, all in favor of adoption, say aye.
Aye.
People say no. Ayes have it. Agenda item number 4, Board Report 2618, quarterly staffing reimbursements for the first quarter of 2026.
Hi,
For the record, this is Lilith Nalbanyan, Benefits Analyst with the Deferred Compensation Plan. This item is requesting approval for reimbursements for city attorney-related costs for the first quarter in the amount of $22,266.86. This is for the quarterly period ending April 4th, 2026. Please note that this includes an adjustment of the first 2 quarters of the city fiscal year due to the change in the cap. Now, 85.49% up from 84.04%. On the second page of the attachment, we are also now showing the personnel department salary updated costs, which also include the adjustment due to the new cap. The rate is now 79.64%, down from 84.19%. We are also now utilizing the 2026 assumptions that were approved during the December 16 board meeting. The assumptions can be found on the bottom of page 2 and the top of page 3. Most notable updates include a fee holiday of 1 quarter in 2026 and a gradual increase of the annual fee cap of $5 annually beginning in 2028 and ending 2031 with a max cap of $135. Page 3 shows the 10-year projection incorporating these very assumptions. Additionally, we have included attachment A to show our cash reserves at the end of the quarter. We started with about 8.1 million, ended with about 5.9 million after encumbrances and liabilities that are still pending. And I can take any questions or if you guys need any further detail for any of these.
Motion to approve?
Let's call for any questions or comments. Hearing none, all in favor of adoption, say aye.
Aye.
Any opposed, say no. Ayes have it. We'll move on to everybody's favorite topic, agenda item number 5, the 2026 fee holiday.
Okay, moving to Board Report 2619, the 2026 fee holiday. For the record, this is Sarah Diolius, Senior Management Analyst with the DCP. The Plan, Governance, and Administrative Issues Committee met in September and December of 2025 for the annual DCP resource review. Among other items, the committee discussed how to reduce the plan's growing surplus. To do this, the committee recommended a fee holiday for 1 quarter in 2026. So since then, staff have been working on a project to make this happen. It was decided that the fee holiday would take place for Q2 of 2026, and communications are being created to inform participants. So far, a blog post has been put up on the website as of late May, and an email, newsletter article, and statement message and a pop-up on the website are in development and scheduled to be released throughout June and July. The 2026 Q2 fee holiday is expected to impact over 57,000 participants and result in approximately $890,000 of reduced revenue. So based on the assumptions and projections outlined in the 2026 DCP annual resource review, the fee holiday is estimated to lower the planned surplus from 3.7 million to 2.8 million. And the committee will meet again in the next coming months for the next annual resource review, and a fee holiday will be provided at that time. Any questions?
We need a motion to approve?
Second.
Well, a second, all in favor. Receiving 5, say aye.
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 Opposed, say no.
We're all just staring at each other.
I was gonna ask a question.
That's okay. You're welcome.
Here. On to agenda item number 6, the update on employer contribution implementation and additional bargaining units to be added.
Thank you. So we do have a few recommendations related to this board report. So I'll go ahead and just walk the board through through the information that has been included. So first and foremost, just wanted to recap again the new employer contribution benefit that has been introduced for the DWP WPERP Tier 2 eligible employees. So the ordinance to amend the deferred compensation plan to make that employer contribution effective was approved through council and posted by city clerk and made effective on March 25th. So thereafter, we did start applying the employer contributions for DWP employees. Thus far, there's been approximately 3 employer contributions that have been credited to eligible employees in their deferred compensation plan accounts. So as a reminder, that is $150 pre-tax monthly that's credited to their accounts if they have 80 hours of qualifying pay in the previous month. So there is a look back period in addition to meeting the eligibility of being IBW and WPERP Tier 2. On page 2, we do have just a schedule related to the payment timeline related to the current agreement. So from January to September, September is when the agreement for IBEW is ended. For those eligible months, we will be paying through October 27th on that paycheck date. Beyond that, it will be dependent upon DWP Labor Relations Office and any continuing negotiations they would be having with IBEW. As a reminder for then the employees that did not have a deferred comp plan account, we did automatically enroll them into the plan. And then per the provisions of our plan document, they were enrolled with an employee deferral of 2% pre-tax. If they remain in the auto enrollment program, so if they don't touch their election, then that 2% will be escalated 0.25% every year. These funds, along with the employer contribution, are deposited directly into the DCP government money market fund. And no later than 120 days, those funds are moved over into our moderate portfolio. So they're given time to opt out of that before that occurs. So when they're auto enrolled, they receive a letter from Voya. They have 30 days before their first employee deduction hits their paycheck to opt out of the plan entirely, though they will continue to receive the employer contribution if they're eligible. And even beyond that, after the first contribution takes, they still have a 90-day window to request what's called a permissible withdrawal. So they'll be able to get a refund within that 90-day period. So there are multiple instances where we do give the employees an opportunity to opt out if this is not the choice for them. But as we all know, the automatic enrollment still will benefit a lot of employees who will, in the end, have some extra savings that they might not miss immediately. Overall, the point to stress though is that the employee may elect to change their employee deferral amount at any time, so they are able to opt out from the automatic enrollment track if they wish. For the first employer contribution payroll, approximately 7,100 employees did receive the $150 employer contribution, and about a little over 2,000 of them are automatically enrolled. So we will have additional data points ongoing to see how many of those remained on the auto enrollment track.
Sorry to interrupt, just real quick on the auto escalator. As soon as an employee goes in and puts a finite percentage or dollar amount, is that what triggers it to stop?
Correct.
Okay. What was the cap on the auto escalation?
So there is no cap.
Oh, it'll go to the max IRS limit.
Correct. Yeah, we just wouldn't let them contribute over the year.
Okay.
But anytime they touch their election or if they change their investment election, it will take them out of that auto enrollment track.
Okay.
So at that point, it's basically then an employee driven account. So there's no, automated provisions for them. So, and then, so subsequently, DWP Labor Relations Office did notify us that that there are 3 additional bargaining units that included what's called Me Too language. So that language is included on the top of page 3. Simply, it just basically says if IBEW gets it, these 3 units will receive this benefit as well, and within the same term that IBEW is receiving this. So as mentioned, IBEW is getting the employer contribution benefit from January to September. So these units will be getting that as well. So in terms of the actual number that are affected, it's going to be approximately a total of 170 employees. We will have to look at whether or not they're all enrolled in deferred comp, but if they're not, then similarly, we would automatically enroll them as well. We will be working with DWP Labor Relations Office and their payroll team to work on any programming changes that need to occur. Since the structure of how that process works has already been set up for the original group, we should have, a roadmap for the DWP payroll team to work on those programming changes. So for our part on staff, it's just to support that effort and help if there's any reconciliation that's needed. Separately, we would be doing some communications, and working with DWP Labor Relations Office to ensure communications to the newly affected group are being sent out, and that we also connect with the new labor units just to make sure that they understand the whole process. So, basically, they will be opting in and mirroring the IBEW letter of intent. So additionally, from the employer contribution, just as an FYI to the board, there is also a retroactive cash component. So for any period before January 2026 that the agreement will cover, DWP will be paying a $150 monthly cash directly to the employee. And then for this, upon implementation, there would be a retroactive employer contribution portion that we would have to catch up in as well, because this would have covered from January, whereas we're in June now. So in terms of any proposed timeline, there are different things to consider. So we have governance. No changes to our administrative code or plan document are required, since we did set up the language for the previous group, and thinking ahead to additional units that could be added. Operationally, I did review that we do need updates to Workday. In terms of Voya system config changes, that should be minimal or not existing, as we've already set up the structure. So we have ensured that any programming really occurs on the DWP payroll side, and that really Voya just accepts the information, and that is credited to employee accounts. On page 4, we have included a sample timeline. So this is basically the quickest this could possibly happen. Ideal scenario, nothing goes wrong, no hiccups. But if the config changes were to begin next week, we would be seeing this hit employee accounts potentially on the August 4th DWP paycheck date. And so we would be building in time for the payroll config changes, for communication processes, and to give employees a chance to also defer from that retroactive cash amount. So if they wish to even defer additionally on that paycheck into their account, we would give them the opportunity to increase their contribution on that paycheck date. So that's more so just a communication challenge, just letting them know, hey, if you want to increase your contribution on this paycheck, you'll have to make it by a certain date. So going through this timeline and the project tasks that are required, we did consider additional items. So this project will require reallocating specific DCP resources from other kind of tasks that we are working on, because it is still additional work. We had been anticipating that this would be kind of more down the line, but with the Me Too language, it kind of requires us to act more immediately. But in the end, I think it still is beneficial to our plan and to the potential participants that will be receiving this benefit, to the extent that we can get it into their accounts faster. So there is a bit of opportunity risk if we were to pen to other things to slot this in. So given also that the agreement ends in September, we would want to just make sure that that is completed, before the term ends. Additionally, we also have to consider the cessation, stopping the employer contribution to auto enrollment piece at the conclusion of the specified labor term agreement. So currently with the LOI language, the automatic enrollment is tied to your eligibility for the employer contribution. So we are in the future, as this is likely to be rolled out to other units. We want to make sure that there is language that is also considerate of the things that we might need to do on our level. So at this time, since the agreement kind of stops there, we have to kind of stop operations, and that requires us to do some changes to the config in the background, process, communication. So, staff, we really wanted to think that through. So Stephen here is here today to kind of talk through, we had been talking about risk management for the plan, so he'll kind of talk us through that portion. But I guess before we talk about the risk part, any other questions related to the benefit that has been implemented or any of the timeline?
I have a question. Well, a success story I just want to share. I'm going to bore the board here for, I promise, no more than 2 minutes. It happened this morning, so I just wanted to share it because one of my concerns with this and my constituents at DWP, we have 12,000-ish employees, 90+% are IBW and over 60% are tier 2. And as you mentioned, it was a very large number that you initially took, and now we have some Me Too clauses, which are common in some contracts. We're familiar with those. So this morning I ran into some tier 2 field workers because one of my main concerns was how is the deferred comp plan communicating with them and how are they reaching them and how well do they understand they chose to do. I was pleasantly surprised. They all received one form of communication, whether it was mail, email, their supervisor telling them whatever it is, and they understood it. They appreciated it, really liked the auto enrollment plan. And that's great, especially for a young new employee who may not be making, senior type salaries, to have that component invested, like you mentioned, early. Again, I'm preaching to the choir on that, but I was pleasantly surprised that they literally had no concerns. They liked it and they received the communication because there's a lot of field workers that aren't as plugged in. So I want to thank the staff on that, that you were able to get out there and get that message to them. I know we did a bulletin, other things. What were the channels though? I guess short, easy question. What were the communication channels and what are they going forward? Are they going to be the same for all the bargaining units?
Well, first, thank you for the for the feedback. And Voya had really helped us with all of the communication as well. So yeah, as you said, multiple points that we had to address. So first and foremost, we did ask the department to DWP Labor Relations released a departmental FAQ document. So from the department itself, I think it's important to receive a communication to say, hey, you're going to be eligible for this new benefit. And then separately, so there were actually multiple communications for the FAQ. And then we also had information posted to our website. So we do have FAQs surrounding auto enrollment and employer contribution. We also did a Money Matters webinar. We also did an in-person informational session at DWP that was also live streamed as well to reach other workers. And then additionally, I think the union also, took it upon themselves as well to communicate with the employees. And so from that, I think going forward, we're going to kind of take from that model and work with labor as well to ensure that they understand the benefit and that we all kind of work together to work on that messaging. So to your point, that they're getting it from different places because we can't always assure that one method is going to reach everyone. So.
Right. Well, great job, guys. I really appreciate it. So I just want to say thank you.
Thank you.
Just had a quick question about the choice of the moderate portfolio for the new accounts. What was the process of choosing that as the place to put the money? And did you have any discussions with either DWP or the union about that? How did you get to that conclusion?
So that portion that was already, so the auto enrollment program was already built into our plan document. So was discussed actually years ago. And Stephen might have more specifics, but initially, I think it was back in 2017-ish when we started talking about auto enrollment. The plan historically or previously had been talking to LAPPL, and they really were our quote unquote pilot group. So I think, Stephen, you had talked to different labor units to come up with this, to go from so basically our default fund option to go into the moderate portfolio. Do you have any?
Yeah, I think the only thing I would add is that it was really intended to be a long-term investment portfolio that would really work for folks who would be working for the city for a long period of time and would make the most sense, and was not making any assumptions about, we think you should take higher risk or lower risk, or we think you should not take any risk. It really was intended to get right to the middle of what that might look like. Also for the purpose of explaining and communicating to participants, in that language uh, of risk using one of the portfolio funds. I think that was a big part of being able to being able to translate that for new folks coming into the program.
And is the selection of the moderate portfolio, is that written into our plan document? It is. So,
Yes.
okay.
So potentially, the board has purview over those components. So if ever we did wish to revisit it, we possibly could. I think that in previous discussions with Mercer and our investment committee, we did see that a lot of newer employees are actually very conservatively invested, and some of our tenured employees were more aggressively invested. So I think there is kind of, the moderate maybe is the place to be for newer folks starting in. But I think as now we're gonna have definitely more sample and examples of this kind of actually being applied to real folks. If there are changes that would need to be considered, that we would bring that back. So then, Stephen, I'll hand it over to you for the risk discussion.
Okay. Well, thank you. So when these changes with the additional units came to light, we thought it would be helpful to incorporate the enterprise risk management or the ERM protocol that we've been using and really apply that, because there are some potential short-term and long-term impacts that are at play here. So from that perspective, we asked ourselves the question, what's the potential primary long-term risk of having changes like these negotiated and then sort of we learn about it after the fact. The risk is actually the very issue that the plan and the board at the time was concerned with when automatic enrollment was first adopted into the plan document, which is that the board at the time didn't want to be administering multiple variations of this. They recognize that multiple versions means greater administrative complexity, potential compliance inconsistencies, and then and also participant confusion about exactly how the program works. So all of those outcomes from the plan level ultimately manifest as a drain on resources. That is one other force then that potentially makes the program less efficient and then pulls it away from its core mission. So for this analysis, we asked ourselves, where are the gaps? And there's really two that we've outlined here. One is a lack of an updated and more comprehensive labor agreement template that could be of use to the parties when they're at the bargaining table. And then a means for the plan being able to insert the priorities and the conditions for participation into the process before the terms are agreed to by the parties. So we propose to address those gaps through two mitigation measures. First, we would like to update and draft new templates for the auto enrollment program and the employer contribution program, fully vetted by staff and the board. And that can be provided in advance to the negotiating parties. As we thought about this more, we also realized that those by themselves are probably insufficient. And so there's additional context that really everybody should be aware of before they begin to contemplate what this might look like practically. There are things that the party should be aware of in terms of what's required to implement this operationally, payroll issues, what we require for administrative setup, what the law requires, what information employees receive, all of that information. So you can kind of think of this as a guidebook that everybody would have access to and could refer to. It helps to both to educate everybody, but also to share information about some of the necessary constraints that the plan needs to be able to follow for the program to be compliant and in accordance with the plan document. So we think both of these mitigations, which are proposed, will hopefully reduce the risk of any kind of future administrative administrative chaos or inefficiency. And with the board's approval, we'll draft those materials and then we'll bring them back to you for consideration.
I have a quick question. So two things. One is obvious. I personally agree having some level of consistency to reduce the chaos is, I think, a very good idea. There's a ton of bargaining units out there that may in future years want this and be able to negotiate it, which would be great. I don't know how you guys would be able to manage it if every single one was different. So I guess two questions. One is, I mean, obviously these are suggestions for the unions because they aren't forced in any way to comply with that. Okay, that's the first question. Second question is, since I don't know the full mechanics of union negotiations, I don't sit at those tables. The Me Too clauses, for example, for these, if there is a Me Too on IBW is using XYZ language, would that in of itself create some level of consistency so that they would have to adopt theirs? And or I think the Me Too works like you get the same or better, perhaps, like they could still negotiate something, but I don't know exactly how the language works on a Me Too, though. I don't know if you know or not, or someone. I don't want to put Sybil on the spot because he's a board member, but
Well, I think the issue with something like this is that the Me Too may be able to, from having the legal authority to move forward, that may be sufficient. That doesn't mean though that the parties have the information. They may not understand because they weren't part of the conversations. So this material needs to be out there and available to help educate, right? And to your point, perhaps some of this, and of course we'd be relying on labor as well as management to share this information, but when they're including something like a Me Too, right, it would be helpful to have this information handy, easy, right? So they're not verbally saying, oh, by the way, but it's here's all the content, here's the information. I think that's kind of what we're trying to get to.
Oh, thanks.
Any other questions? So we're being asked to consider a three-part recommendation on this.
A motion to move forward with all three.
I'll second.
Any other questions or comments? Hearing none, all in favor of adoption, say aye.
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 Any opposed, say no. Ayes have it. We will then jump over to agenda item number 8, which is the DCP projects and activities report for March and April 2026.
So just a few highlights and updates. The investments consulting RFP has been posted to the city's procurement website portal, Ramp LA. That was posted on May 29th. So that is to our current contract with our investment management consultant, Mercer, ends at the end of this year. So we'll be procuring for that service and coming back to the board with recommendations after the proposals are submitted. So proposals are requested by July 15th. So it will take us some time to evaluate and come back with the recommendations to the board. So we're hoping to do that in approximately September or October board meeting. And then just wanted to provide a quick update related to web accessibility compliance. So we had reported to the board that the DOJ had basically some regulations for us to comply with accessibility requirements by the initial deadline of April 2026. But luckily, DOJ has been generous and granted a deadline at least for another year to make sure that governments of our size are compliant. So we'll have some additional time on that, which is very we are relieved. Proxy voting activity. There has been no activity since we last reported to this board related to that, but we did include just a note here for the record. If the board recalls, we do periodically receive proxy voting ballots from our underlying funds. So as we get them, we will continue to report on them and take action as included in our investment policy statement. Related to the fiscal year 25-26 unpaid holidays, just wanted to note that staff did observe at least one full day in February and then 1 hour in March related to the unpaid holiday. We had requested an exemption, but that was not granted at that time. And I will pass to Sarah for additional update.
Thank you. Okay, elections. As a reminder, elections have taken place this year for two positions on the board, the active LACER seat and the active LAFPP seat. In early March, the election notification and calendar were mailed to participants, and a social media post was also published, which directed participants to the DCP election page for more information and ongoing updates. The candidate filing period spanned the last weeks of March into early April and resulted in the eligibility of 3 candidates running for the LACERS election and 2 candidates for the LAFPP election. Voters received their ballots early April. City clerk provided a preliminary notice mid-May indicating to the DCP that the initial number of ballots received was lower than expected. So in response, staff provided we quickly created content for an email blast, which was sent out the next day. Voting concluded on May 22nd, 2026. And in the end, the number of cast votes did stabilize to a more standardized level. Yeah. Unofficial results have been released. So both incumbents won their respective elections. So Matthew Benham and Carl Lurvy will continue to serve on the board with their new terms set at 5 years beginning July 1st. So congratulations. And city clerk will be releasing the finalized results soon. And wrapping up RMDs for 2025, BOY conducts RMD sweeps twice a year to make sure participants are meeting their distribution requirements. The recent March 25th, 2026 sweep processed 2025 RMDs for 123 participants with a total of $848,953 distributed. Okay, and then moving on to communications updates. For our anchor campaigns, Women in Retirement launched during Women's History Month, mid-March, and it has a dedicated page on the DCP site. And in addition to the webpage, the campaign was also announced via email, postcard, social media post, and had its own Money Matters session. And that session explored issues that specifically impact women's ability to plan for retirement and provided guidance for improving outcomes. The session was really well attended, and participants in particular expressed gratitude for that session, so that was good. As a May update, since the report was published, the Women in Retirement page has been updated with fresh new content. The other anchor campaign is Your Money Made Easy. This campaign's been delayed compared to the proposed schedule due to other issues that have come up, such as for elections, the DWP employer contribution, fee holiday, to name a few, which took priority. So far for the campaign, an introduction email, social media post, and newsletter article were released in late April. The Q1, okay, moving on to Q1 statements and the April 2026 newsletter, those were distributed. Some newsletter highlights, it featured a reminder for eligible participants to vote in the 2026 board elections prior to the election date. It had introductions to both anchor campaigns, and it featured an article on estate planning and beneficiaries, which complemented the April Money Matters session on that same topic. And for the local counselor survey, participants who meet with local counselors are sent a survey after their appointment to give feedback on their experience. The results for that survey are provided in attachment A. The DCP also submitted an entry to the Leadership Award nomination for NAGDA for DCP's 2025 NRSM campaign, Your Path, Your Plan. And that submission is provided in attachment B. For Money Matters for March and April, 3 Money Matters sessions were held in those 2 months. The 2 scheduled Money Matters included a session for the Women in Retirement Anchor campaign and a session related to beneficiaries and trusts. So in addition to the scheduled ones, a session was created for the DWP employer contribution that was recently implemented. So holding a Money Matters session for that was an efficient way to convey information to a group of people and answer questions rather than local reps and DCP addressing participants individually with the same questions. Yeah, so although we did provide those services, we also prioritized responding to employer contribution inquiries that we received. And for our website statistics, website engagement stats are also provided for March and April. Notably, the Women in Retirement page reached top 10 when the campaign first launched in March. Okay. Any questions or comments?
Moving on to agenda item number 9, any requests for future agenda items?
I just had a question on timing for Esther. On your opening comments, you were talking about potentially having underestimated some of the resource constraints. When do you guys come back to us for the next fiscal budget for positions and everything else? When does it happen?
Thank you for the question. So for our annual resource review, that will be occurring in July or August. So that's what we normally will have the plan governance and administrative issues committee to meet. And then we'll come back with recommendations to the fuller board. So we do meet earlier on in the year so that in case there are any budget requests that we need to submit, that we can meet that deadline, because for the city, usually those are due in October-ish.
Cool, thanks.
With that, the next meeting is our regular meeting scheduled for June 16th, 2026. And with that, we are adjourned. Thank you, everybody.
Thank you.
Thank you.
Yeah. Yeah, yeah. Yeah, you can use it in the exec suite.